Nobody outside the tech industry has heard of this company. But if it stopped shipping tomorrow, every AI accelerator on Earth would grind to a halt within months. That company is TSMC, Taiwan Semiconductor Manufacturing, and it makes roughly 90% of the world's most advanced chips. Not designs them, not brands them, actually manufactures them. For Nvidia, Apple, AMD, and basically every other chip company you've heard of. This is what TSMC actually does. How one engineer's contrarian bet in 1987 became a $1.94 trillion company. And why the same dominance that makes it indispensable also makes it one of the biggest single points of failure in the entire global economy. On July 16, 2026, TSMC reported second quarter revenue of $40.20 billion, up 33.7% from a year earlier and 12% from the quarter before. Gross margin, 67.7%. Operating margin, 60.3%. Those are software company margins on a business that pours tens of billions into physical factories every year. And the guidance for next quarter goes even higher, $44.6 to $45.8 billion. A hardware company posting the margins of a monopoly, because in the part of the chip industry that matters most, it basically is one. TSMC is a Taiwanese semiconductor company, headquartered in Hsinchu, trading on the New York Stock Exchange as TSM. It has a market cap of roughly $1.94 trillion on trailing revenue of $139.6 billion, with a gross margin north of 67%. Here's the number that matters most. Its forward price-to-earnings ratio sits at about 19, for a company guided to grow revenue over 40% this year. The stock is up roughly 80% in 12 months, and Wall Street still doesn't think it's expensive. TSMC doesn't design chips, and it doesn't sell anything under its own brand. It manufactures chips that other companies design. The business model is called a pure-play foundry, and TSMC invented it. There are 3 tiers: leading-edge logic, 7 nanometers and below, which is 77% of wafer revenue; advanced packaging, the process that stacks and connects multiple chiplets into one working AI accelerator, which is where a lot of Nvidia's GPU actually gets assembled; and mature and specialty nodes, the unglamorous chips in cars, sensors, and everyday electronics. Last year alone, 305 distinct process technologies for 534 customers. Apple and Nvidia are the 2 names everyone recognizes. They're a small fraction of the actual list. Here's how TSMC actually got here. 1987, 56-year-old Morris Chang founds the company on a contrarian idea, a factory that makes chips for other companies, instead of designing and selling its own. 1994, lists on the Taiwan Stock Exchange. 1997, becomes the first Taiwanese company on the New York Stock Exchange, with ADRs priced at $24.78 each. 2020, announces its first ever U.S. fab in Arizona. 2024, C.C. Wei becomes both chairman and CEO. March 2025, expands that U.S. investment to $165 billion, the largest greenfield foreign investment in American history. June 4, 2026, Wei tells shareholders directly that advanced packaging capacity is sold out through the end of the year. July 16, record second quarter revenue of $40.2 billion, guided even higher. And by August, market cap near $1.94 trillion, up from a $24.78 ADR price in 1997. So what does TSMC say comes next? Its 2-nanometer node enters what management itself calls a steep ramp-up through the second half of this year. It's 3% of revenue today. Advanced packaging capacity, the CoWoS bottleneck behind most AI GPUs, stays tight. TSMC has doubled it 3 years running, and it's still not enough. Capital spending lands near $62 billion this year, funding the build-out. In Arizona, 3 fabs, 2 advanced packaging facilities, and a research center on that $165 billion commitment. The next bottleneck after packaging, by TSMC's own admission, ABF substrates. And underneath all of it sits an uncomfortable bet that building more capacity overseas doesn't quietly erode the exact strategic leverage that's kept Taiwan safe. So what's TSMC's actual edge? Scale nobody else has matched, roughly 70% of the entire global foundry market. Technology leadership, about 90% of the world's most advanced chips run through TSMC specifically. A packaging monopoly, roughly 95% of advanced AI chip packaging, sold out through this year. And breadth. 305 process technologies serving 534 customers. Not a bet on any single node or any single client. None of that guarantees TSMC stays untouchable forever. It does mean that, right now, there is no real alternative supply chain for the chips the entire AI industry depends on. So how does TSMC stack up against Samsung Foundry, the closest thing it has to a rival? Samsung holds about 7% of the foundry market to TSMC's 70, a 63-point gap that's actually widening, not closing. Against Intel Foundry, still ramping its 18A node, still trying to convince outside customers to trust a process it hasn't proven at scale. And there's a structural point that doesn't show up in the market share numbers. Samsung and Intel both design and sell their own chips, which means any customer using their foundry is also handing designs to a competitor. TSMC makes nothing under its own name. For a lot of chip designers, that alone settles the decision before price ever comes up. Asked about Samsung's push to catch up in advanced chips, Chairman and CEO C.C. Wei didn't hedge. Quote, "A dream that's been repeating for 20 years. Samsung has spent billions trying to close that gap for 2 decades. Over that same stretch, the gap didn't shrink. It widened to 63 percentage points. None of this comes without risk. There's the silicon shield itself. The theory that Taiwan's safety depends partly on the rest of the world needing TSMC too much to allow a disruption. A shield that gets weaker every time TSMC builds more capacity somewhere else. There's concentration. Apple and Nvidia alone drive an outsized share of revenue. There's capital intensity, roughly $62 billion a year, rising, with no guarantee demand keeps pace. There's geopolitics, China-Taiwan tension that no factory, anywhere, can build around. And there's the ordinary cyclicality every semiconductor company eventually faces. Even TSMC's own 2-nanometer ramp is a bet that demand shows up exactly when management says it will. So why does any of this matter beyond one company's earnings call? Because TSMC's own numbers are the clearest evidence that the entire AI build-out has a single physical choke point, and it sits inside one island. The bull case, software company margins on a hardware business, a forward multiple that still looks reasonable, and a moat, 70% of foundry share, 90% of advanced chips, 95% of AI packaging. That 2 decades of competition hasn't dented. The bear case, the more indispensable TSMC becomes, the more the entire global economy's fortunes ride on the stability of one company, in one place, that faces real geopolitical risk no balance sheet can hedge away. So which is it? The safest, highest margin bet in the entire AI trade? Or the single point of failure the whole industry has quietly agreed not to talk about? Comment your take below.